Good day, financial professionals. I'm Bill Anderson, Wealth Strategist with E4 Insurance Services. Welcome to our video log we call The Brew, Building Relationships Every Week. Thanks for tuning in today. For those of you joining The Brew for the first time, welcome. We like to start the Brewcast by celebrating today's national days. Did you know it's National Bagel Day, it's National Hat Day, and National Strawberry Ice Cream Day? I know it's a little bit corny, but we do this on The Brew every week on this recording. So I guess you can wear your hat, go get yourself some strawberry ice cream and a bagel. So on today's Brew, we're continuing our estate planning as our focus for January. Joining us is industry specialist CPA John Polski from the Minneapolis-St. Paul area. And we're going to discuss today income tax planning under the new regime change that's taking place 5 days from today. Yes, if you're looking at this on the recording, this was filmed or videoed on January 15th of 2025. John, we've all looked at Google and found what are the 5 to 10 questions that you should ask a CPA accountant when you're hiring them. They range from what's your experience to how do you charge for your services, etc. But John, from your point of view, what are the top 2 or 3 questions a client should be asking you if they're going to hire you?
Well, number one, whether they hire me or not, they should be asking about the procedures for estate planning and what's important and what really isn't important, such as the most important items is the team that they pick. The lawyer, CPA, and in your situation, financial advisor. And those 3 people are extremely important in the estate planning scheme here. A will, obviously, without a doubt, is the most important thing to have. I can't tell you how many times people walk through my door, I ask them the same question, do you have a will? I get no's quite a bit, and it's just crazy. Got to have a will. A lot of other certain smaller items that are important, but I think the team and the will are the 2 most important things to address when you're looking at estate planning, whether you're talking to a CPA, your friends, a lawyer, financial advisor, whoever.
Yeah, thank you for that. Appreciate your comments on the team. I agree, very, very important. Everybody needs to be on the same page. And those meetings before the meetings and then after the meetings to keep the team together, right? From your tax planning point of view, how important is a will or a deed on death?
A will is mandatory. You got to have a will. Now, a living trust can go with a will, which basically the only thing a living trust, it's a revocable trust, and the only thing it will really do for you is bypass probate. But a deed on death will do the same thing, just depending on what costs and where your head's at when it comes to that. But we do a lot of living trusts, basically.
Right. Yeah. And then how about that medical or healthcare directive or part of the trust?
Well, that would be part of the irrevocable type trusts. Okay. Now, there's quite a few that can help people in estate planning, medical trust, special needs trust, charitable remainder trust, a spousal trust, spendthrift. I mean, just all sorts of trusts that we can't get into, really, technically right now. But the pluses and the minuses, I would just like to give you a real quick synopsis on that. The pluses are these trusts can basically protect your assets from estate taxes and protect your assets from creditors and basically do what you want with your estate in the event of your death. The bad points are a lot of these trusts, as a general rule, when they're irrevocable, do not get what's called a stepped up basis on the assets within the trust. So a quick example would be, let's say a couple own an apartment building. They paid $2 million for it, it's worth $10 million right now. If that apartment building is in an irrevocable trust, most likely it will not get a stepped up basis, which is the fair market value on death for the beneficiaries whenever that might happen. That's a bad point. But depending on, what size of an estate we're dealing with, you just have to kind of gauge the benefits versus the non-benefits of it.
Right. Thank you for that. Yeah, a lot of people forget about that. We do that irrevocable planning, and we might put some access provisions to that trust, but that basis stays there a long
Exactly.
time.
You
And I
gotta
guess
look.
the reality is, from a tax point of view, is somebody, while they're still alive, gifts a piece of property into that sort of a trust. It's not the date of which that gift was made. It goes all the way back to their original basis, right?
Correct.
Yeah.
Original cost basis.
Yep. So last week on the Brew, Kevin Crouch did a fantastic job of just outlining things estate planning wise. He was a nationally known attorney from Savannah, Georgia. He talked about things in the estate, but as we were preparing for today's Brew, one of the things that clicked in my brain is I want to ask the question of you, John, what makes up a taxable estate?
Generally, a taxable estate would be any assets, fair market value at death of any assets owned by that particular deceased person. Any assets. It can get complicated. It can be simple or it can be very complicated. But basically, bank accounts, real estate, stocks, bonds, the whole ball of wax. Whatever that fair market value is on the date of their death, that is going to be their gross estate number.
Right.
And then whether it's a taxable estate or not depends on what the taxable estate exemption happens to be at that point.
Awesome. Thank you for that. So, with the upcoming political change in DC next week, there's a question I asked Kevin last week, and I enjoyed his opinion, but I'd like to get your opinion as well. So, what is your point of view on what might happen on the gift and estate tax levels and that sunset or no sunset that happens at the end of this year, where everything goes back to an original $5 to $7 million number, I believe it is, on January 1, 2026, or not? What are your thoughts from the tax planning point of view?
I think the upcoming president, with what he's been telling us, is probably going to use estate taxes as a bank account to make up for what he's promised the American public, like not taxing Social Security. So I think that sunset or that phase out is going to go back to either 5 or 7 million. The popular opinion is 7, not 5. So $7 million exemption on a federal level. Minnesota, we just don't know. It'll probably stay at 3, I hope. 3 million.
And let's talk about that, Minnesota. So Minnesota has its own state tax, as does roughly 13 or 15 other states out there. Will it stay at the 3,000? And will Maryland's at 5 million? It's 3 million in Minnesota. I want to say Illinois is at 4 million. I think they all kind of follow the same, either line up with the federal numbers or they're completely separate. So what do you think there?
Well, Minnesota's completely separate, always has
Yep.
been, always done their own thing versus the federal tax changes. I think it's going to stay at 3 million. I hope. I hope it doesn't go down, but you know what? They could go and follow the IRS's or the federal government and just slash it in half. They slash it in half, we're at 1.5 million. And that brings a whole lot more people into the mix as far as estate problems. I mean, a whole lot more. So it's just going to depend on where our money is in the state, deficit or a plus, and how much pressure the legislation gets by all factions, us as citizens and, different types of legislators.
Sure.
It's going to be interesting. And no one really, I mean, I've asked this question, Bill, so many times in the last 3-4 months to people in the know. Nobody knows what's going to happen in Minnesota. But I'm hoping it'll stay at 3 million.
Well, thank you for your thoughts on that. I know there's a good size or a good portion of our audience that are from Minnesota. And if they're not from there, they've got clients there and they care about what could happen, right?
Maybe our Minnesota clients would like to know that Minnesota is in the top 5 when it comes to the lowest tax exemption on an estate. Not the highest, the lowest.
Right.
That just puts us way up there again as the number 3 maybe in the country as far as being taxed. And a very good point of, maybe I shouldn't even say this to people, we won't get in any trouble, but a good estate plan is to move out of this estate or this state when your estate value reaches a certain point. There is no look back period on that. So you move to a non-taxable estate. Let's say someone who's got a $20 million estate. I mean, a person would be very smart to move to Florida or anywhere else that has a low estate or no estate type tax. But
well, thank you. So I hope everybody heard that. You should move out of Minnesota.
No, I just hope the revenue department doesn't get on my case here.
Thank you for that thought. All right. Knowing that the audience is primarily advisors, from money managers to insurance professionals, many RIAs and IARs, what do you, John, look for in an advisor when you want to do, share a client with them, right? So knowing that strategic relationships are a two-way street, what's important to you when you're partnering with another advisor?
Most important thing is that the advisor will listen to me and basically get into a discussion on what's best for the client, not particularly what might be best for the advisor's bottom line. And most of the advisors I deal with, obviously you and being one, do care more for the client than they care for their bottom line, which is a good thing. I have not had a major problem with any advisor before, but cooperation between the team is a necessity. Everybody needs to listen, and you can't have alpha dogs in the situation. Everybody's got their own ideas and thoughts, and everyone's got to listen to them.
Right. I found it very interesting also in our prep call, the number of people, the number of leads and referrals that you get in a given year's time and where they come from. Could you share that with everybody?
As far as a CPA goes?
Yep. CPAs and advisors.
I think
blew me away.
I get a lot of people coming from law firms and advisory firms. Charles Schwab, other advisors, et cetera, et cetera. That's where most of my referrals come from, actually.
Isn't that great?
In the state area,
awesome.
A lot of law firms. A lot of them don't do that type of work, but they want a CPA to come in and give them advice, and then I might even bring in somebody like you on that situation if they want it. But
yeah, awesome. So I always like to close the questions, if you will. Is there a question, John, that has not been asked yet today that you would love to have the audience know about?
Well, I'll tell you what, I would love the audience to know about what they should have. And they should have a will, they should have a team, they should have a power of attorney, they should start their estate planning early, don't wait till the last minute. They should review that plan, they should talk to their family members, which is very important, about their estate plan. You do not want a lot of hostility or a lot of court action after you pass away, which is pretty dominant in today's society. But you want cooperation from everybody. And basically, aside from looking with your team at trust type situations and how it fits, just make sure that the client knows all the pros and cons of what you're suggesting. I mean, obviously, it's easy to suggest a positive thing about a trust, but then tell them about negative also, so they can make an informed decision of what they're doing.
Thank you. Thank you for that. We have a question from our what I call the live studio audience today, to the point of moving out of unfriendly estate tax states. Does property owned get taxed in the state it is located, or do the taxes follow to the residency of the owner?
The estate tax would follow the residency of the owner, but there can be taxation to the state where the property is involved, like Minnesota. If you own an
Right.
apartment building here, yeah, you're going to get taxed on the sale of it. But if you're not a resident here, they cannot pick and choose assets which apply to Minnesota tax as far as an estate level goes, but on a personal level, they can.
Right. So let's say that we've got let's make up a number of a $15 million estate, and husband and wife made that move from Minnesota down to Florida. Let's say that one of their properties was worth $8 million under today's Minnesota state estate tax rules, right? So the property is located in Minnesota for 8 million. The rest of their wealth is in Florida at 7 million. What happens on the Minnesota state estate tax upon the passing of both the husband and wife?
As far as I know, nothing would happen if they are not residents of Minnesota.
Okay, so
In
the
that
property owned
situation,
in Minnesota, yeah, the
property owned in
Minnesota.
Minnesota, property owned in Minnesota has different attributes to it for taxation.
Okay,
Okay, and it gets very complicated. But
sure.
as far as adding that property or filing a Minnesota state tax return, I believe we wouldn't have to if you're not a resident of Minnesota.
Good
But
to
I
know.
can certainly research that too. That's a good question.
We can, yeah, let's follow that up on the recording of this brew. We'll attach it to the end of it just to kind of close that loop. So appreciate that.
Minnesota is a very aggressive state when it comes to that. So things change quite a bit. And that's something that I would like to look at before I give you my best answer. Let's put it that way.
Appreciate that. Yes, thank you. So thank you for the questions. If there are any more questions, go ahead and just do that in the chat box, please. I want to remind you that all attendees are entered into a drawing for a CE voucher and a Starbucks gift card. We're going to announce that shortly. So John, thank you for joining today and giving us your thoughts. Let me see if there's any other questions that have come in. Here's something. Can you clarify that regarding state estate taxes? For example, a North Dakota residents with a Minnesota Lake home, if they are over the Minnesota state exemption limits, the property in Minnesota would be subject to a state tax based upon a formula of total estates and assets in Minnesota. So that's kind of what you just answered. Yeah. Anything you want to add to that, John, or?
Not really.
Okay, yeah.
But there are I will research that because that is an interesting question.
Yep. When is the ideal time to start planning? Is it in your 40s or 50s, or is that at a certain net worth level?
You know, any time's a good time. I mean, a will, I don't care how old you are. You know, as long as you're, 21, you should have a will. You really should. But, it's a personal preference. But when you actually start real estate planning, it can be not real estate, but I mean, actually planning your estate. It would be dictated on the net worth of your estate. If you have a non-taxable estate, there still are a lot of things that you might want to consider, obviously, in a will.
Yeah, appreciate that. I've got one more question for you from the chat box, which makes sense. In the estate planning arena, we're always talking about long-term care, right? So from a CPA tax viewpoint, what advice do you give clients that are experiencing a long-term care event with no insurance in place?
No insurance in place.
Yeah, so let's say they're spending $12,000 a month towards expenses of long-term care out of their pocket. Is there any tax planning advice?
There are various types of medical trusts, some which would exclude their assets from, let's call it medical assistance, if you want to call it that. So that could free up. I mean, they want to look at some sort of medical trust, the possibility of it.
Right.
Absolutely.
Okay.
But there are a few different types, and they are very complicated, and they need a very competent lawyer in that situation to set up the trust.
Yep. And then back to that team of you as the tax or a tax person advising with that legal person involved,
absolutely,
correct?
Absolutely.
Yeah. Awesome.
And in that team, everyone needs to get along, and obviously the client needs to like everybody and trust everybody, and competency levels need to be high when it comes to estate planning.
Super. All right. Well, again, John, thank you for your thoughts. We very much appreciate this today. Now let's do the giveaway. So, John, a number between 1 and 49, please.
23.
23. All right. Hey. So, Carrie Holland, you are the winner of the Starbucks card and the complimentary CE voucher. So, watch for an email on that. Next week on The Brew, we will continue with estate planning. Myself and Brett Miras, Field Vice President with Pacific Life, is going to share, he's going to share the ideas and hot topics, the solutions for clients moving forward, especially under what we call Secure Act 2.0. They're going to be tried and tested strategies that are coming to the forefront of solutions for your clients. So just feel free to join us next week. And thanks everybody for your time. John, again, thank you for your time. We so much appreciate this.
My pleasure.
And yes, and we will see you all next time on The Brew.